Prudential regulations governing banking, ensuring safety and soundness of banks. Presentation overview. Prudential regulations. Prudential regulations are designed to ensure the safety and stability of the financial system and protect the interests of depositors and investors. These regulations are important to prevent banking crises and systemic risk. Capital adequacy and liquidity requirements. Banks must adhere to the capital adequacy and liquidity requirements to ensure that they have sufficient capital and liquidity to absorb losses and withstand financial shocks. These requirements are designed to protect depositors and promote financial stability. Credit risk management. Credit risk is the risk of loss arising from a borrower's failure to repay a loan or meet its obligations. Effective credit risk management is essential to ensure that banks are able to assess credit risk, set appropriate loan provisions, and manage risk effectively. Operational and market risk management. Operational and market risks are the risks associated with the day-to-day operations of a bank and the broader financial markets. Effective operational and market risk management is essential to identify potential risks, develop risk mitigation strategies, and ensure the safety and soundness of the financial system. Introduction to Prudential Regulations. What are prudential regulations? Prudential regulations are rules that banks must follow to ensure their safety and soundness. They are designed to protect investors and depositors and the broader financial system for the risk of bank failures. Why are prudential regulations important? Prudential regulations are important because they help to maintain the stability of the financial system. By ensuring that banks operate in a safe and sound manner, these regulations help to prevent financial crises. How are prudential regulations enforced? Prudential regulations are enforced by regulatory agencies such as the Federal Reserve, the FDIC, and the OCC. These agencies are responsible for supervising banks and enforcing compliance with prudential regulations. What are prudential regulations? Prudential regulations are a set of rules that banks must follow to ensure their safety and soundness. These regulations are designed to protect the interests of depositors and the overall stability of the financial system. Why are prudential regulations important? Prudential regulations are important because they help to maintain the stability of the banking system and protect depositors' funds. By ensuring that banks have adequate capital and liquidity, they are managing their risks effectively. Regulators can help to prevent bank failures and financial crises. Capital adequacy and liquidity requirements. Capital adequacy requirements. Capital adequacy requirements refer to the amount of capital a bank must maintain in relation to its risk-weighted assets. These requirements are designed to ensure that banks have sufficient resources to absorb losses and continue operating under adverse conditions. Liquidity requirements. Liquidity requirements refer to a bank's ability to meet its financial obligations as they come due without incurring significant losses. Banks must maintain a certain level of liquid assets to ensure they have enough cash on hand to meet their obligations. Minimum capital requirements. Banks must maintain a minimum level of capital to absorb losses. The minimum capital requirement is the amount of capital that a bank is required to hold to ensure its solvency and stability in the event of unexpected losses. Components of capital. The components of capital include equity and debt. Equity includes common and preferred stock, while debt includes long-term and short-term debt, subordinated debts, and other forms of capital that can absorb losses. Liquidity coverage ratio. The liquidity coverage ratio is a key component of the liquidity requirement that banks must follow to ensure they have sufficient liquidity in times of distress. It requires banks to maintain a certain level of high-quality liquid assets that can be easily converted to cash. Credit risk management. Credit risk assessment. Credit risk assessment is the process of evaluating a borrower's ability to repay a loan and the likelihood of default. It is an essential aspect of credit risk management. Credit risk mitigation. Credit risk mitigation involves taking steps to reduce the risk of default, such as requiring collateral or credit insurance. It is an important aspect of credit risk management. Credit risk monitoring. Credit risk monitoring involves continuously monitoring the credit worthiness of borrowers and taking corrective actions when necessary. It is a key aspect of credit risk management. Credit risk assessment. Credit worthiness assessment. Banks use various methods to assess the credit worthiness of borrowers, including analyzing their credit history, income, and other financial data. Credit scoring models. Banks use credit scoring models to evaluate the credit risk of borrowers. Credit scoring models use statistical algorithms to analyze borrower data and generate a score that represents their credit worthiness. Collateral. Banks may require borrowers to provide collateral to secure a loan. Collateral is an asset that the bank can take possession of if the borrower defaults on the loan. Loan provisioning. Banks must set aside provisions for expected loan losses. They can use different approaches to calculate these provisions, including the incurred loss model and the expected loss model. Incurred loss model. The incurred loss model is a historical approach to loan provisioning where banks recognize losses only when they become evident. Expected loss model. The expected loss model is a forward-looking approach to loan provisioning where banks recognize expected losses over the life of a loan and adjust their provisions accordingly. Operational and market risk management. Operational risk. Operational risk is the risk of loss resulting from inadequate or failed internal processes, people, and systems. This includes risks from fraud, errors, and disruptions in operations. Market risk. Market risk is the risk of loss resulting from changes in market conditions, such as interest rates, exchange rates, and commodity prices. Banks can manage market risk by diversifying their portfolios and hedging against market fluctuations. Operational risk management. Operational risk management is a crucial aspect of banking. There are various methods that banks can use to manage operational risk, such as risk assessment, internal controls, and business continuity planning. Market risk management. Market risk. Market risk is the risk of loss due to changes in market conditions, such as interest rates or exchange rates. Market risk management techniques. Banks use various techniques to manage market risks, such as diversification, hedging, and limit setting. Conclusion. Prudential regulations are essential for ensuring the safety and soundness of the banking system. By maintaining adequate capital and liquidity, effectively managing credit, operational and market risks, and adhering to other regulatory requirements, banks can help to prevent financial crises and protect depositors' funds. Thank you.